I was one of the big bulls on silver for the last few years and took a lot of heat for the fact that silver took a while to get going. But silver, as you point out, is outperforming now, as typically when the precious metals are in a bull market, silver will outperform gold. In this letter, I am raising my target. I was already pretty high on the street with a $75 target pre-bust. I am raising that to 100. And again, same thing. I think it's a thin metal that is just starting to get sponsorship. And, retail's been there. A lot of, certainly those that dabble in the metals have been there for many months, but the institutions really ignored silver and are just starting. So, I may be low at 100, but I'll take 100 pre-bust. Post bust, I have big targets for both gold and silver by early next decade. So probably 2031 or two, you could see silver at $500 and gold at 20,000. And that seemed more far fetched when gold was down at 2,500. But if it goes to 5,000 pre bust, I mean that's not a far fetched number in an environment which I think the post bust cycle will be, that is going to be very, very inflationary and very pro commodity. So I think 20,000 seems more reasonable every day.
Yeah, it absolutely does. Definitely doesn't seem out of the ordinary with how both gold and silver have been performing so far. Now, you also called the move in the GDX ETF from $22 to $75. Now we're here at around $78. Would you be taking profits here? Do you think there's still room to run? Is it early days for the gold mining sector at this point?
Yeah, it's interesting because, again, I kind of had to wait for my letter because I always try to change my targets, give them to subscribers, and then I'll put it out on social media. But when it pushed beyond 75, people are going, you're missing it or whatever. I said, no, just wait. There was, particularly on GDXJ, a target right around here. GXJ has run up to, which is the junior gold miners, has run up to 102 or 3. And right around there was a pretty significant intermediate top. There's a higher high above this, quite a bit above this 102.3 area. But it looked like if it wanted to, if there was given a reason that you might get a 20 or 30% correction, they've had big runs, they're overbought. So I was kind of saying, well, I got to wait for my letter anyway. Let's see what happens. I'm more of the opinion now that the miners are going to keep going here because I think the metals are poised for a lot more. So I think they're not, technical. When you look at history and you look at the charts long term, sometimes those inflection points mean something, and sometimes they blow right through them. So still too early to know for sure, but I think the odds are that we're not going to see much of a correction here. And I have raised my target on GDX to 120. I raised my target on GDXJ to 170, which is the all-time high. And so you can see there's 50, 70% upsides in those things. Silver, the SIL, larger silver miners, was 75, and I've raised that. I can't remember what my number is now. And my SILJ target, which had been 35 and for a long time looked like that was a reach. I've raised that, even though we're down in the mid 20s. I've raised that to 60 because I think the smaller miners, the more developmental miners, the ones that explore and develop and don't have real production facilities yet. A lot of those, once silver gets going, they're going to probably fly. So I think there's a lot of room, particularly in the smaller miners, both gold and silver, for a big upside here.
I want to read something you wrote on X recently where you said the bust is not in any way determined by market levels. The stock market and the economy, though correlated in some ways, are two entirely different entities. I forecast what I expect markets to do, and I forecast what I expect the economy to do independent of one another. Can you walk us through your thought process here and where the economy and stock markets are correlated and where you see them acting as separate entities?
Yeah, they tend to follow the same cycle. Obviously, the stock market's moving up when you're in a recovery cycle or when you're in a positive economic cycle, and when you have recessions and worse, the stock market will it hurts earnings, it hurts companies, and so the stock market follows suit. Now, typically, the market leads the economy. So I was by no means not trying to de-link those. What I was really getting at is that people think that my stock forecast, if I change something there, it means I'm changing my economic forecast, and it doesn't work that precisely that that's the case because there are lots of factors that go into the shorter term movement in the stock market. So, raising my S&P number to 9,500 is in no way putting off the global bust. It's not saying okay, because I think we're in a blow off. It's just that it's a bigger blow off than I could anticipate a year ago or 6 months ago, even. Um, but yeah, I mean, people I find too often, particularly retail investors, um, act like a bust is a stock market. When I talk bust, I'm talking specifically about the economy and the financial system in general. When I talk about the linking of or the related stock market, it's a bear market that goes along with that bust. So it's really kind of just to get at those people who think that if my forecast in equities is changing, then I'm giving up my view on what's coming in the economy, and I'm not at all.
And how much do you think passive inflows into ETFs are continuing this blow off top longer than you said even you anticipated 6 months ago? Because I believe now the number of publicly listed ETFs has surpassed the number of single company stocks, at least in the United States, which is a pretty interesting statistic. And of course, the Jack Bogle method of just put everything into an index fund and that's all you have to do has taken hold over the past, several decades, couple decades, I would say. And we're now at a point where success kind of begets success in the sense that these are market capitalization weighted indexes. So the Mag 7 keeps on getting perhaps bigger than it would otherwise. Does that play a major role in your view when it comes to the trajectory of the market at present?
Actually, I don't think so. I think it certainly plays some role, but I think we would see something similar to this, even if that were not the landscape we have. It's really, in my opinion, it's more where we are in the super cycle in the grand scheme of things that you have going back. I call a super cycle the long cycle between two depressions. So the 1930s being the last depression. I think the mid 2030s is probably the next depression. So you're in the last decade of a super cycle, and what happens is you come out of the depression. You have you've cleansed the system. Obviously, you're coming out of deflation. You're coming out of a period when everything's flat on its back, or things are down on the floor, and you have no excesses. So the first couple of cycles out of that, you come out, you have nice growth. When you start seeing inflation pick up to whatever it was back in the 40s and early 50s, maybe 5% seemed high. So you ratchet it back down. Didn't take huge ratcheting down to do it. But each successive cycle, you end up with bigger excesses in various places, but inflation being one, but speculation being another, et cetera. And what happens is as you move farther away from the previous depression, you get um, bigger highs and bigger lows. In other words, it takes you end up going to more extremes. It's kind of a buggy whip type of cycle to cycle type volatility. So it takes bigger. You go to bigger excesses each successive cycle, or pretty much each successive cycle, and then you take more. It takes more of ratcheting down, tightening down from the Fed to wind out those excesses, and because of that, they tend to go too far. Then you get more excesses on the downside that require bigger ups in terms of the stimulus, and because of leads and lags, they're always going too far in each direction. But as you get farther removed from the depression, those cycles get more violent or get more extreme. And we're now in that ninth decade away from that. And we saw in 2008-9 a very big extreme, and I think most people assumed that you don't see another extreme that quickly after that. But I think this being the next big cycle, we're actually going to see a bigger down, because of the bigger excesses that are being cranked down and bigger errors that get made by the central bank because it's hard to figure out because of the leads and lags. So I think it has more to do with that